Hello and welcome back to All Things Money. I'm your host for the show, David Blain, and during today's show, we're digging in depth into President Obama's 2013 budget proposal, mostly, well, virtually all relating to the tax proposals contained in that. A lot of people are concerned about, well, if he gets reelected, what's it going to do to my taxes and how can I start planning? So we wanted to do some in-depth research on that and let you know what's going on with the proposal. So when we left off before the first break, which, by the way, if you missed the first segment, head on over to our website, dlblain.com. You'll find archived copies of the show and you can listen to what we talked about in the first segment. We're really just kind of getting into the specifics now, but he proposed to reinstate the 36 and 39.6 rate up from the maximum of 35%. And just kind of a side note, 39.6, let's just round it to 40 to keep my math easy. If you're self-employed and you own a business and you're in the 39.6% tax bracket, so you're going to pay 40% in federal income tax. You have to pay 15.3% Social Security and Medicare. Once again, we'll round that one down to 15%. So we're up to 55%. And then you go, and depending on what state you live in here in North Carolina, depending on whether they have the surcharge or not the surcharge year, but just we'll round it to, say, 8%. So 40% federal, 15% Social Security and Medicare tax, that's 55%, and then another 8% state tax. You're talking about 63% of a self-employed person's income at the higher brackets going to taxes. It's just way too much. Of course, then they take that 47% that they have left over, 37% that they have left over, and then they've got to go buy food, and then they get hit with another 7% tax. They need to go buy a house. They get hit with property tax. It's way, way too much. Talk about fair share. It's just way too much. Okay, back to the proposals. President Obama is once again proposing to tax qualified dividends as ordinary income, unlike the 15% that's currently in place today. He's also proposing to tax long-term capital gains at 20% as opposed to the 15% today. Well, actually, in the lowest tax brackets, it's 0% capital gains rate today for people in the 10 or 15% tax bracket. Most people forget about that or they don't know that. But if you're in a low tax bracket, capital gains is free. There is no capital gains tax. It's a wonderful tax break for middle Americans as he's proposing to eliminate. Here's the big one we alluded to prior. Reducing the value of certain tax expenditures. And this is where, they want to sock it to the people making all the money. Well, there's some unintended consequences here. So what he's proposing is that all itemized deductions would only apply to income that's taxed at no more than 28%. Now keep in mind, one of the principles of this is to simplify the tax code. And if you think this is going to simplify the tax code, I mean, there's no way. This is going to make it incredibly more complex than it is today. You take an itemized deduction. Remember, he wants to reinstate that 3%, what I call haircut, 3% haircut. We also have the taxation coming in under the new Social Security and Medicare law of 3.8%. And now he wants to limit these deductions for people in the higher than 28% tax bracket. And this would include everything from, it would be including tax-exempt municipal bond interest. It would eliminate that deduction. Eliminate employer-sponsored health insurance paid by employers or employees with pre-tax dollars. It would eliminate the health insurance costs of self-employed individuals. It would eliminate the deductibility of employee contributions to retirement plans such as 401ks. It would eliminate HSA contributions, Archer medical savings accounts, interest on education loans, and certain higher education expenses. I mean, these are major changes to the tax law that are going to impact, a lot of people. It's going to filter through the economy. In the last segment, so make sure you tune back in for the last segment, we'll go through a little bit more detailed analysis. I want to get through the proposals right now So taxing the carried interest as ordinary income of private partnerships, hedge funds. I'm really not going to talk too much about this. Restoring the estate, gift, and generation skipping tax back to 2009. And this was where you had a $3.5 million exemption. The gift tax exclusion was $1 million. Current law is that at the end of 2012, it revert back to the 2011 scenario, which was $1 million gift and estate exclusion, top rate of 55%. So by going back to the 2009, it's actually a little bit more favorable in some respects than if we let the Bush tax cuts expire. Anyway, there are some additional things in there, most of which have been never seen before. Modifying the rules on the valuation discounts. This applies to some family partnerships. Really messing with the grantor trust, grantor retained annuity trust, as well as grantor trust. I'm not going to get into too much detail on that other than my comments, but really changing some of the fundamental nature of some of these estate planning techniques. I think the defective grantor trust came into effect somewhere around 1954 was when these things started first appearing based on some of the rules, and President Obama proposing to really eliminate some of these estate planning vehicles. Okay, so that's the basic proposals that he have. In the last segment here, we're going to go through and I'm going to give you some detailed analysis and what I think it's going to impact. So for All Things Money, I'm your host, David Blain. We'll be right back after a few short messages from our sponsors.